here. So today we're going to take a quick step back, and I want to give you the overview of what hard money lending actually accomplishes. Hard money loans can be categorized or described in different ways. You'll sometimes hear them called private loans. You'll sometimes hear them called hard money loans, or you'll sometimes hear them called asset-based loans. Basically, they can be used interchangeably. Now, let's look here. What type of loans are considered private or hard money? Well, first you have a bridge loan. Now, what's a bridge loan? Now, a bridge loan is a loan that is typically shorter in term, somewhere around 90 to 2 years, 90 days to 2 years. And it's typically used in a fix and flip deal where someone is trying to purchase a distressed home or a home that needs fixing up, or a piece of property that needs fixing up, and they intend to renovate it and either resell it or renovate it and refinance it into a longer term 30-year fixed loan, or some type of loan that has a longer fixed rate. The typical rates are going to be around 8 to 12%. That's typically what the market is offering. And the loan to value, what is the loan to value? Loan to value is basically the amount of the loan in ratio to what the appraised value would be for that property. Okay, that can run close to an appraised value, but you honestly want to, you'll hear wholesalers talk about after repair value, and that is basically an estimation or a comp that a wholesaler will calculate, looking at homes that are in that particular neighborhood or close in the proximity to the home that they're looking to fix up. And what they do is they look at what that home looks like in comparison to what a renovated property looks like in that neighborhood, to consider the appraised value, because that is what a bridge lender is going to look at. The next type of private loan, or hard money, or asset-based loan that we're going to talk about are the transactional loans. Now, transactional loan is used for quick buys. So again, we'll go back to a wholesaler, or we'll go back to an investor who's looking to buy a distressed property and can't quite get the money lined up, or something could go wrong where an investor has a closing date for a property and they're 1 or 2 days from the table of closing, and the lender that they're working with can't get the deal done in time. So they will go to a hard money or an asset-based lender who will lend them money from a short term, from anywhere from, they say 1 day, but normally it's about anywhere from 3 days to a year. Now, again, the contract typically would state that, the transactional lender is going to lend for this particular day. So the contract may say 7 days, you'll get the loan of this money for 7 days. And if you go over that, they're going to start charging you at an annual rate. So they'll charge you an interest rate per day, but they'll prorate it over 12 months. So as you see, the typical rate is about 2 to 4%, depending upon which transactional lender or hard money lender, is on the deal. And they typically will loan up to 90% of the value. Now, in a situation like that, the property should be appraised. So you should have the appraisal back from the original lender. If you don't have the appraisal situation back from that original lender, you probably would need to get an appraisal done on your own of that property and be able to provide that to the transactional lender, so that lender could have that in order to close. A construction loan. Now, this is typically for new constructions, even land, acquiring land and additions to properties. But the term is typically from 6 months to a year. Now, the ironic thing is, it typically takes about 9 months in our market for, a 3,000 square foot home to actually be completed. But the loans tend to start in 6 months. So there's always a 90-day area of negotiation. So the rate would be prime plus 1. And then again, if you exceed it, the term, the rate would annualize at 10 to 12%. So you're basically paying around 1% a month in interest on that loan until it was actually satisfied. Now, typically construction loans are structured in a way where once the property is completed, that loan would be converted into a fixed loan. And that fixed loan would typically be, something more conventional, FHA or some type of VA loan that could be backed by the government. Now, a DSCR loan. Okay, a DSCR loan are basically loans that private investors, and again, private investors can be a one-person shop, can be a team of friends that have put their money together, like my group, or it could be a large hedge fund that is institutionally backed. But anyway, these loans are typically for rental properties and commercial properties. And really, commercial properties, if you look at it, are basically rental properties, because what do commercial properties typically have? Tenants, right? Debt service coverage ratio loans are basically loans where the premise is that the lender is not looking at an individual's credit score. The lender is looking at the income that this particular rental or piece of property is producing. It's typically within a range, the term range would be 5 years and 30 years. And I mean, you would see some advertising of 6% rates. This is 2023, but you're really looking in the 8%, 7-8% range. I have seen people who have a lot of properties able to obtain rates maybe right at 6% right now. So if you can get that, then you may want to jump on it. Up to 80%, depending upon what your experience is, how well the property is producing. But typically on a mom and pop investor, you're probably looking more at the 65-70%. So you're going to have to come to the table with some money or bring some partners in that have some money. Land loans. These are the type of loans for acquiring land. Typically, if you're acquiring land, it's not bringing in any money. It's just land. So a land loan is for a long-term private investor that, can look at the appreciation or look at the value of that. They typically be willing to lend at a rate of at a term of 1 to 15 years. They're looking for these same 7 to 10. If you look, you're looking at, pretty much all of these hard money loans are coming in that 6 to 10%. And basically, depending upon these loans, you will see that depending upon these loans, depending upon what type of loan it is, it depends on the comfort level of the lender. So typically a bridge loan, and there's a reason why I haven't gotten the home equity loans yet. So let's just go here. So with bridge loans, again, typically a fix and flip or some type of rehab or renovation project. So the lenders are going to have experience with this. They probably were fix and flippers or construction people before they got into lending. Transactional, probably people who were used to wholesaling, people who are used to assigning contracts, people who are used to acquiring properties. Construction, probably a construction company. A home builder. A lot of times the people who fund these construction loans are actually the builder. They'll have a separate mortgage company where they will institute construction lending, or you will have local banks, community banks, hold construction loans because they actually are banking within the neighborhoods or in the surrounding neighborhoods that are being built. These DSCR lenders, landlords, or people, or property apartment building owners, or people who are used to or have experience with rental properties. Land lenders are people who like land, developers. Now, finally, home equity loans. These are lenders who don't mind giving out cash or cashing out someone who has a position in the property. You can have a situation. I bought a property like this before where the house was $700,000. Purchase price was $700,000. The loan required 10% down, which would have been $70,000. The loan limit was $525 in that county, so there needed to be about $100,000 second loan. So a local bank was willing to go into second position and put a second loan, a home equity loan, on that property. So that's how that would be used. Terms typically 15 years. Home equity loans. Okay, so in recap, private loans equal hard money loans equal asset-based loans. It's basically all the same things. We've gone over the different types, the reasons why you would use each particular loan type, the typical terms and rates, and the typical required loan to value of each loan type. Thanks for watching, and remember, go out, learn, and do. Stop worrying about other people's business and take care of your own. Till the next time, peace.